Hello, and welcome to the Cadent Quarterly Newsletter. As you can tell, we're coming to you in a new format, video content this quarter to try out something new and hopefully a little bit more dynamic that you enjoy. We'll still share our viewpoint on economic, market, and financial planning topics, and we'd love your feedback once you've experienced this and whether you like it and how you experience it relative to the old hard-written copies.
We also now have the chance to share some exciting happenings at Cadent Capital. So as you saw in Casey's email last week, we have added a new team member. Erin Champlin is our new client service associate. We are thrilled to have her on board, and she is looking forward to meeting all of you and working with you. In addition, we are coming to you live from our temporary office suite in Crestview Tower. We are fully functional and enjoying the transition while our actual office suite is under construction one floor below us, but we are really excited to be in Las Colinas and can't wait to have you all here. If you stay tuned, we'll share some live shots of the construction scene. We'll keep you posted as we progress through it. But let's dive into our economic outlook. So we'll start with the topic that is heavy on all of our hearts, the Russia and Ukraine conflict. And while we do not want to be dismissive about the saddened losses that are going on over there, we do want to address what we're seeing as potential economic impacts as a result of this conflict. So Casey, what are you seeing?
Yeah, and you hit the nail on the head. I mean, it is a very trying time from a personal perspective. The human toll is significant and seems to be growing. But from an economic and market perspective, we still feel it is relatively isolated. And I don't mean isolated geographically. I mean isolated in terms of scale of the economic and market impact. And the primary reason behind that is simply in terms of GDP, or the value of all goods and services produced in a particular country. Russia only represents 3% of GDP in the globe. And so all of the sanctions that are being applied to them, their inability to maybe sell their goods to other parts of the globe being disrupted, the economic impact of that is still relatively, again, isolated. Additionally, another larger impact is the disruption to supply chain and labor markets. This was already disrupted with COVID. And as we started to work through some of that weakness, now we have another headwind or another challenge that needs to be worked through.
And as you stated, the results of disrupted supply chain that came from COVID was a contributing factor to inflation. And there were a number of economic impacts from the pandemic. So Casey, where do we stand on inflation, on unemployment, and just other lingering effects of the pandemic?
Yeah, well, the short version is we're well beyond the transitory period, which I think is probably a surprise to no one. Even the Fed is on board finally saying that we're no longer in a transitory period of inflation. But we've sat at over 7% year over year inflation for a few months now. The latest headline inflation was 7.9%. And clearly, to the extent that persists, that will be disruptive over time. The most significant way that's disruptive is with loss of purchasing power on safe assets. We'll probably touch on that a bit more in a little bit. But the supply chain disruptions are another leg of potential inflation. So the material markets, anytime that goods can't move from one place to another, suppliers, purchasers, manufacturers have to reroute where they get things from to build their ultimate end products. That causes scarcity, at least in the short term, as that is reworked and causes prices to go up commonly. Additionally, and I think a more significant impact for continued inflation for a period is the disruption in the labor markets. We are back to 3.8% unemployment, which is a healthy level. That's getting near full employment, albeit a soft level. And the reason I say it's soft is because unemployment is actually probably higher than that, but there's a lot of recent retirees. There are industries like healthcare workers where there's a lot on sabbatical where they could be induced back if wages were strong enough to induce them back. Or in the case of a lot of the healthcare workers and other related industries, if the bonuses and extra pay that are keeping their cash accounts or bank accounts flush for the moment exhaust themselves at some point, like they likely will, they'll have to come back to work. But the main reason that there's a disconnect in the supply and demand for labor is simply the number of job openings. Right now, we're sitting at a little over 11.25 million job openings. And whether we're near full employment or just nearing full employment, when we have double the job openings that we've experienced over the last 20 years, that is a significant supply and demand disconnect for labor that should drive further inflation. Doesn't mean that inflation will be higher from this level. It just means it will be higher than we would like to see, say 3% for a persistent period. We would expect, not putting a number on it, but a couple of years as a reasonable expectation for the labor market to work itself out.
Recently, the Fed announced that they are raising interest rates by 25 basis points or 1/4%. While this has been signaled for quite some time, now that it's in effect, we are seeing direct impacts specifically in the bond market. So Casey, you want to comment more on that?
Right, and that's a challenge that we've been pretty vocal about and consistent about for a year plus. Again, the Fed, as you said, was signaling that rate hikes would be coming, and a dynamic that we know well, and many of you may know as well, is that as interest rates rise, bond prices fall. And that's a simple mathematical relationship that we can we'll pause on today. If you want to talk about it with us some other time, the concept is called duration, and we'll be happy to nerd out with you in a one-on-one conversation. But if you just accept that as a fact, that as interest rates rise, bond prices fall, it's likely no surprise that all bond returns are negative year to date in an environment where interest rates are rising. And when I say all fixed income, I virtually mean that. All of the major bond components or bond segments are negative year to date. And that is a little bit frustrating, I would say, for those that are investing in the market, because not only do we have a challenging fixed income environment with more rate hikes likely, therefore more pressure on bond prices to the negative, but also a turbulent equity market. So if stocks are risky or scary and fixed income is in for more expected challenges and cash and fixed income is losing purchasing power to inflation, it makes for a turbulent time for trying to maintain discipline and focus and invest with confidence. But nonetheless, we still continue to view equity risk as the most favorable of those. Simply put, there's the opportunity for surprise return. There's the opportunity for even muddled return, where the economic strife is slowing down return, but there's still some positive potential, whether it's from inflation impacts translating to earnings or multiple lift or any number of reasons. But that almost known loss that we expect in fixed income and cash relative to inflation, that's not so much a risk as known pain that we're trying to avoid or minimize.
While we know that we live in a world that is constantly changing, we at Cadent maintain our long-term financial planning-based approach to building portfolios and doing life with all of you. While we balance the long-term risk with being informed on short-term opportunities and challenges that we face, we know that a financial plan and staying disciplined to it for the long term is the best way to go. A disruption to that would be any changes in your lives. Has income changed? Are there unexpected expenses or any sort of changes that we haven't already talked about and planned for? Let us know. We prioritize, again, a long-term plan with near-term cash flow planning, and we'll continue to maintain a disciplined approach.
Yeah, and not all surprises are to the negative. If you've had positive changes to your income or life, that does allow another lever, the opportunity to be opportunistic. It doesn't mean we need to pounce and get those dollars invested right away, or jump on whatever opportunity that creates, but at least it invites a conversation that we would love to have.
In closing, please enjoy these live shots from our under construction office space, and we give you a glimpse of what it looks like now so that we can do a full reveal of the glorious new space that we'll be meeting with you going forward.
All right. Thank you.